Now, welcome back. In the previous session, we talked about how we produce a very basic consolidated statement of financial position. As I told you in the beginning, when you talk about consolidation, we have three different documents. Actually, not three, five, but mostly we concentrate on three. One is consolidated statement of financial position. Other one is consolidated statement of comprehensive income, and then consolidated statement of cash flow. So these three documents you should know how to produce. Now, as a matter of basic understanding, in the previous session we discussed some basic workings. What are those? We had to arrive the group structure, what has happened in the acquisition, we found that out, and then secondly, we also get to know how to calculate goodwill, and further we also learn basic consolidated retained earnings for reserves, and then we talked about what is non-controlling interest, and then accordingly we produced the financial statement, or we produced the consolidated statement of financial position. In short, we call it balance sheet. Now, today what we'll do is that we try to find out how we produce a consolidated statement of comprehensive income or consolidated profit and loss account. We try to find that out. Now, let's say I have a parent company, and then I have a subsidiary company. I have a parent company, the parent has invested on subsidiary company. The scenario could be different. Scenario could be either 100% fully owned subsidiary, either 80% owned subsidiary. This is one possibility. Another scenario is the date of acquisition. The date of acquisition could be the same date when the company incorporated, or the date of acquisition could be after the company already has been incorporated by someone else. So you have to analyze all of these information at very beginning. Once you are done with that, then we need to understand how we prepare a consolidated statement of comprehensive income. So in doing that, what actually the key factors are, now they will give you the consolidated statement of income or comprehensive income for parent company, and they will give you the consolidated comprehensive income for subsidiary company. Now, in this example, I have one parent and one subsidiary. So that means two entities. So when I have now parent and one subsidiary, only one. So two entities. When I have two entities, the number of columns you will see here, 1, 2, 3, 4 columns I have. So that 4 column how I arrive, n plus 2. This n means the number of entities including the parent. Now I have the parent 1, subsidiary 1, total 2. So instead of n, I will write 2 there. So 2 plus 2, that becomes 4. So I have the 4 columns here. So the third column, we need to say that adjustments. Any relevant adjustments with regard to this particular scenario, we will put down in this column. And the fourth column is consolidation column. Now, if you are appearing exam, so the examiner, what most important is, he will not worry about this column, this column, this column. He doesn't worry about that. He only wants this column. And suppose you completed your question and left at this point, and if you are not reproduced, or if I name this description, if you don't reproduce the description column and consolidated column separately again, you're going to lose 2 marks. So this is from an examination point of view. So just for your information. So this is what the basic structure of format is. Now what's going to happen now? They will give you sales because you know profit and loss account or income statement starts with sales. The sales of the parent they will give you. Sales of the subsidiary they will give you. Suppose if the information do not available with regard to any, there is something called intercompany sales. Do you know what the meaning of intercompany sales? Let's say the parent is vehicle manufacturing company, subsidiary is a tire manufacturing company. And the tire manufacturing company, what they do, they produce the tire and then they sell that tires to parent. So this sales that the subsidiary is making to parent is known as intercompany sales. So when you have intercompany sales, this is still within the same umbrella. So any intercompany sales is not considered to be a sales to outside world. So when I had to consolidate, you see what for example, let's say the intercompany sales here A, the number dollars A assume. So then now within this number, within this figure, now the parent, okay, subsidiary. Now in this scenario, as I explained to you, the subsidiary is selling goods to parent, and the sales value is dollar A. Okay, let me put down a number. $100 or 100 million, think like this. Now the subsidiary selling $100 million worth of goods to parent. Now in this number written here, let me also say, for example, this is 1 million or 1,000 million. This is 150 or 750, for example. So the parent company total sales 1,000, subsidiaries total sales 750. In this, subsidiary have made a sale of 100 to parent. So the sales figure 750 already including this 100. So when I am consolidating, my net sales to the outside world is how much? What should I do? I should eliminate this 100 from this. So what I will do, I will subtract that 100 from this 750. Is that clear? That is 60 today. Okay. Oh. Right. So 1,750 minus 100. So your sales, consolidated sales will be 1,650. Now we come on to talk about cost of sales. Now let's assume the cost of sales for parent is 600 and for subsidiary let's assume 350. Now who purchased? Parent purchased. No, parent purchased from subsidiary how much? No, from subsidiary 100. Now this 600 includes that 100. Yes or no? And also see, there are so many different complicated scenarios they are going to develop here. Now, all of these 100, they may have kept in warehouse. Half of that has been sold. 75% has been sold. Like that, different story is going to, they are going to budge into this. But now, we just assume they purchased entire 100 and then they sold all 100. All of that 100 million worth of tires purchased from subsidiary has been sold fully to the outside world. Make that presumption or assumption. So this 600 includes that 100. But this is 100 is purchased from whom? Outside world or from internal company? Internal company. This is an intercompany transaction. So what I have to do, you see, here we subtract this, right? So I have to add back. So then, what will be my answer? 600 plus 350, 950 minus 100. This is one important adjustment in consolidated income statement. Clear? So you have then you have gross profit. So 400. This is also 400, right? Coincident. So this is 0, and here, so this answer must be 800. Clear?
Yes.
So then we have expenses. Or no, before expenses. Now sometimes, subsidiary may pay dividends. When the subsidiary is paying dividends, the parent will receive dividends. Subsidiary will pay dividend, parent will receive dividend. According to IAS 1, a company who paying dividend, are we showing as an expense or are we showing that as part of equity adjustment? We discussed IAS 1 in the Moses regime. Paham told himself. Okay, tell me then, if you remember, tell me what we should do with the dividends we pay. Can we consider that as expense? Any dividends, can you consider that as expense? We cannot consider dividend payments as an expense. Dividend is an adjustment in our statement of changes in equity. But the company who receives dividend is an income. Correct? So, the parent company have received dividends received. Let's say 10 for example. So this 10 for the, now this 10 received from whom? No, from subsidiary. Parent received from subsidiary. But when I am consolidating, it's like you know, in my trouser I have two pockets. I have 10 riyal in this pocket, I remove out and then put that 10 riyal into this pocket. Is there any physical change in that money? No. No. Same story here. So, what you should do, you should subtract your 10 and then you will arrive in this. And then you have your expenses. All your expenses will come. But from a format point of view, IAS 1 speaks about how you produce an income statement. Then you have administrative expense, selling and distribution expense, all that will come in, and then let's say for example 75, 35. Okay, so no adjustment here. So 75, 35, it is 110. Then I have profit before interest and tax. Then I will have to subtract any interest or finance cost. So the finance cost, they will also, you can find it that in the question. So you can say 12, 6, so that is 18. No, sorry, okay. 18 will come here. Then after that, you have profit before tax. Once you subtract the interest, the next answer is profit before tax. Then you have the tax. Then you get, let's say, 40, 28, 68. Then I have profit for the year. I have the profit for the year. Now at this point, now if the subsidiary, I mean, if you look into this, suppose situation like this, when the parent has invested only 80%, then the 20% shareholders also there. So they need to entertain or enjoy the profits of the subsidiary. Now that profit of the subsidiary is that answer coming here. I'm sorry, not here. Here. So this, on this profit, a percentage should be given to whom? A percentage should be given to the non-controlling interest shareholders, right? So I have, let us just balance this. 410 minus 75. Could you someone do the hard work for me, please? No, I can't wait for you all. Let me open my calculator. 410 minus 75.
335, 323.
335,
323.
323 and 200 and 283.
287.
No, 287 in the back.
Sorry.
283. Sure, no? So then this one, 400 minus 35, 365, 359, and then minus 28. And then this 10 will continue. Okay. Now 283 plus minus 604. And we name this as what? We name this profit for the year. Now what we do is that the job is not finished yet. What to now do? We have to do a small working, additional working known as profit attributable to parent, shareholders, NCI. See, the total profit is 604. And how much we are going to give it to?
80%.
Yeah, 80% to the parent.
Yes.
Now, how much we are going to give it to non-controlling interest shareholders? 20% of what profit? On exactly. So this will be 331 into 20%. How I got 331? That is here. How I got 20%? That is from this. 100 minus 80% will give you 20%. So what is the answer then?
66.
331 into 0.2, 66.2. And this is the balancing figure. 604 minus. Huh? Ah, okay, no worries.
Screen on.
Screen on.
Next class you can't drive now.
Inshallah. Allahumma min side.
Finish your drink today.
Yes. But you still didn't give me breakfast.
After Ramadan.
Masalama yani.
We'll finish Ramadan.
Before you go, before 10-15 years before Sri Lanka houses, if there's a pregnant lady, you put in the board. Adana means not today, tomorrow. If anybody comes to ask anything, not today, tomorrow. So tomorrow you come back, not today, tomorrow. So anyway, you come and see, not today, tomorrow. Tomorrow never comes.
No, the practice in immigration before in Qatar. Whenever you go in the morning, you have inshallah mukla. Same thing he says. Bukla will come inshallah.
Thal
And also in the shops, they put today cash, tomorrow credit.
Tomorrow never comes.
Anyway, so
The more of the story is you buy now, not
Yes.
tomorrow.
yes. So what we want to say, give a message, run towards some restaurant will do it for us. Anyway, the balancing figure. The balancing figure is 604 minus 62.507.8. Remember, this is the profit for the year. Now, this we have done with the profit and loss account. Then, we need to prepare the balance sheet. Then, when preparing balance sheet, we also need to do an analysis of return earnings. Analysis of return earnings. All of you know what is return earnings, by the way? Retail earning? No. Retained earnings. Yeah, Habibi, yeah.
Answer.
Shareholder.
Huh?
Shareholder.
Shareholder? Shareholder sleeping at home?
No, the partners.
Partners what?
Divided by the profit like that.
Rose? Return earnings. Married? Asma?
What's your name, brother?
Nasman.
Nasman.
Yeah.
Can you tell me what is return earning? Yeah, Mansoor. Submit.
Return in this.
Return earnings.
We have one.
I will write in full
one
form.
picture.
Okay.
This one.
Hello?
This is
Not
the-
earrings, huh?
This one.
Not earrings.
This is
Maybe
return from the profits.
Huh?
Return from the profits.
The pain.
Return from the
Profits.
profits over the.
All the same.
Financial
The pain, but the liability is it's there.
See, what happens is, it's like that. You remember we talked about the pot. We talked about that pot. You remember?
The
Yes.
mother's house, then there are
Yes.
things that are pain.
And what is left over there?
Is the
Let's
pain.
say on 31st December 2020, I have 100 here. Now we come to 2021. And then on 1 January 2020, this 100 will continue here, right? So that is what I try to mean retain earnings. So this from this 100, here I have 100, and for this year, I then have, let's say, another 300. So on 31st December 21, what will be my return earning then? 400. So this is the point that I wanted to talk
It's
about.
the accumulated profit each year.
Yeah,
It's called
at the
return
end of,
earning.
correct. At the end of any given year, what is the total profits that we have?
Accumulated. Each year accumulated.
So, we have to perform an analysis of the retained earnings in producing the consolidated statement of financial position. Now, when you remember when we have done the balance sheet, I have done a consolidated return earning. One table, parent company, subsidiary company, and then as per question, same thing you may have to perform. Now, if there is a loss, What will happen if there is a loss?
You don't have return.
Then it's a retained loss. It's not
Retained
return
loss.
earning, it's a debit balance. Now normally return earning is a credit balance. If it's a retained losses, it will be debit balance. So it will reduce the value of equity. It will reduce the value of equity. Clear?
400 million over there, right? 300 plus 100, 400 million. Next year it makes a 100 million loss. And then 400 million minus 100. Okay?
It will be like that.
When his profit will be adding, increasing. If his loss is
So
reducing.
now today my target is, after making you understand this, I just wanted to talk about specific adjustments. There are different specific adjustments I would like to discuss with. Number one, we call it unrealized profit. What do you think unrealized profit is? Any idea? Anyone can tell me what is unrealized profits?
What is deferred revenue?
Deferred revenue is what?
We explained 2 times. What is deferred revenue? Anybody remember?
So we need to have a mechanism of punishment. So
Penalties, fines.
yes, mukalaha. Starting with
No point having classes if you forgot. Huh? What is the deferred revenue?
Chala book
Go ahead, revise the
We
notes.
discussing the tax part. Deferred revenue.
that is deferred tax.
Tax.
Deferred tax.
It's not deferred
It
revenue.
is the
Deferred revenue is something
This
else.
the
Straight what we have to discuss.
how many years? Right?
No.
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 Receive cash and not provide expense.
That is the
Anna,
revenue not yet earned. Simple.
today I come to Haider Holding, I receive 200 million riyals inshallah, and then I don't offer any services. I keep on waiting, and in my balance sheet, that's a liability for me.
So you must realize profit.
No, that's
Unrealized. This is different.
This is something another concept.
Concept is same.
Okay. Now what is unrealized profit? Let's assume now parent selling goods to subsidiary. Selling goods and or services to subsidiary. If you end up with toothache, no toothache, right? Because you have toothache.
And realize profit.
Okay. Now, when the parent is selling goods to subsidiary, this arrangement we have a special name. This we named it. Downstream transactions. It's coming from top to bottom, parent to subsidiary. So it's a downstream transaction. Now, if subsidiary selling goods to parent, how I name this? Subsidiary selling goods and or services to parent. We name this as
What do you call that? Huh? What do you call it?
Upstream.
Of course. Down, opposite is up, no?
Upstream.
Transaction.
transactions. Please remember this. There are two different types of transactions. If the parent is selling goods to subsidiary downstream, if the subsidiary is selling goods to parent upstream. Now, in any given situation,
Yeah, NGC service was upstream or downstream?
This is was downstream.
Sure.
so if the parent and the subsidiary ownership relationship, if the ownership is 100%, meaning 100% on subsidiary, regardless of whether it is a upstream or downstream, still the treatment is same. When if the parent has 100% ownership on the subsidiary, then the way you going to deal with this topic, the topic what I have written here, is that this topic, unrealized topics, the methodology will be same. But when the ownership, let's say for example 70%. If I have 70%, meaning NCA shareholders will have an ownership of 30%. So now, let's take an example. Parent company sells goods worth 1 million to subsidiary. %30 of the goods are still in the warehouse of subsidiary. Parent used to have 25% markup. Parent invests 75% shares in subsidiary. Now, can we do this calculation? No? Yeah, it's in the requirement, right? Okay, thank you. Right. Parent company sells goods worth 1,000. So then you need to assume, yeah, please. You need to assume this is sales, huh? To subsidiary, 30% of the goods are still in the warehouse of subsidiary. Parent used to have 25% markup on all the goods that they sell. Parent invests 75% shares in subsidiary. Now, first of all, you all should know the difference between the word markup and the word margin. Yes, someone can help me know what is markup. What is markup?
Markup, same margin.
Same margin.
Percentage
Percentage of profits. Yes, madam. You tell me.
No, same margin. Margin percentage from the total.
I will kill you now.
No. Markup.
Physically all about
Percentage
it.
from the profit. But the margin percentage from the cost of the.
Mashallah.
Percentage of the cost.
Okay. They say, no. Who sell goods to whom now? Parent is selling goods to subsidiary. So it's a upstream transaction or downstream transaction? It's a downstream transaction. That's the first point. It's the income stream. Secondly,
Also, we know the time.
hmm?
We the charge.
Where?
We
Inshallah from tomorrow. He also said they also don't have battery exchange. From tomorrow they will start charging.
Yes, indeed.
Okay. See, second point is that in the subsidiary warehouse, they have but the percentage of stocks they are unable to sell outside world.
%30.
30%. So 30% meaning how much?
$300.
300. 30% meaning 300. Now also relating this to another argument, IAS 2. What is IAS 2 now? Yeah.
how you made it there?
You are the
I will say that's all.
yes, you come with the habaya better. Okay, yeah, Mansur. What is IAS 2 now? Inventory, accounting for inventory. Accounting for inventory says what? Inventory should be valued at lower of cost or NRP. Now, the parent company has sold goods to subsidiary at a value of 1,000. 1,000 is the cost to parent or sales price of parent? To the parent. It's an invoice value or it's a cost value? This 1,000 is for the parent is invoice value or cost value? In the books of the parent, this 1,000 they will show it under sales or cost of sales.
Cost.
Sales.
Sales?
Cost
Cost of sales?
Cost.
Cost of sales? You have done with you in your office?
Sales.
Who will show?
It is sales.
Alhamdulillah.
It is sales. So parent company they will report as sales, but the subsidiary, assume there is no relationship between parent and subsidiary. Two different, totally different companies. And if that S company buying goods worth of 1,000 from P, now what is the cost to S then? Cost to S will be how much? 1,000, right? So on that 1,000, 30% they have not sold. So how much is the balance in the warehouse? 300 will be sitting in the warehouse. But the issue is these two companies are related. These two companies are parent and subsidiary. We are going to prepare a consolidated financial statement. Then we should consider these two entities as a single entity. In that situation, we have to go back and refer to IAS to find out this 300 is reporting at what value? 300 is the sales value to the parent. But do you know what the cost to the parent? Can you work out? In working out, you should know the difference between markup and margin. What is markup? When I have sales, cost and profit, they said 25, right? When the cost is 100 and the sales will be 125 in percentage, this arrangement is known as markup. When your profit is based on cost, that arrangement is known as markup. When 25. Your sales is 100 and the cost is 75. This is markup and this will become. Please understand this difference. I will not be able to repeat this every time and again. So this has to be registered in the brains of so-called accountants. Clear? Fine. Now, so 1000 sales value is 1000. How much is the sales value? 1000. Now, I need to find out the cost. Can someone do the calculation for me, please? Yeah, I would expect it's not to scare the board and wait. Take calculator, pen, pencil, paper, and do the working. If you know, if you understood properly what is markup, you can calculate this. And this is in percentage. And here it is actual terms. So, what is the cost? How much? Still thinking? Okay, you keep on thinking.
The question. The question.
Question is here. Okay, I was used to be a boxer before. Yes, madam. $750? Sure? Okay. What is the answer, Gogo?
Yes, sir.
Okay, I'm waiting. You want me one, my weight 65 kilos. Well, see, it's to happen today. No.
250?
No.
5.
Mr. Ziraj, please bring that gun. I need to start. You have AK-47?
We should have plan and findings.
Yes. Malayahi.
No, when he asked after the course should we keep an exam, I said no. Right? But next time if it's the case, we have to keep the exam. Whoever failed, we have penalties.
See
No,
here.
whatever is course fee, I will take from the salaries. So next time, remember, when you do revise, go and revise.
Actual sales value.
1,000.
I need this.
Cost.
Very simple. Go back to your school days. They teach you 4 mangoes, $12. 5 mangoes or 8 mangoes, how much? Oh, no, 7 mangoes, how much? How to calculate? 21? How you calculate it? Tell me please.
Divided by 4,
What divided by 4?
that will
That one means what?
1 mangoes area.
So this is 12 divided by 4 into, this what you did. So same thing here. 125 mango, $1,000. 100 mango, how much?
So 100. What's the question?
That's a good question.
You know what's the best thing to do? Hang all upside down. So the blood flow will be good to the brain. Then you understand more clearly.
Good morning. Welcome back.
Take the calculator. Do 1000 divided by 125 into 100. How much? You can't do by this one. Do the calculator. Use the calculator. 1000 divided by 125 into 100.
I don't know. Let me reconfirm that. I thought. Okay. Yeah, I confirm from my side, I said. Okay. Yeah. Okay, no issue.
125 into 100.
125 into 100.
Yeah,
800.
okay. Sir, now at the moment I am in the middle of a lecture. Yeah. Okay, once I'm done, I'll call you back and you send me the account number, no issues. Yeah, fine, no issues. Okay. Yeah, so how to do that? 1000 divided by 125 multiplied by 100. This is 5, this is 4, this is 200, and that means 800. So 800 is the cost for you. So here 800, so that means 200 is the profit. Clear? Right. Now 30% is still with them. So from this, I told you that we should value inventories using cost of NRV. So what is the, now see, my cost is how much? My cost is 800, and of that cost 30% is still with them. So how much is that? 800 into 30%, which is 240. So there is a difference between these two. How much is that? This 60 is what? This 60 is known as unrealized profits. 60 is known as unrealized profits. So I can do the same calculation using this. You see, 300, 100 over 125 into 30 over 100. 300 into 100 over 125. Now can you work out and find out how much is this? What's the answers? Okay, so what is the answer? 100 into 300 into 100 over 125 into 30 over 100. And you should understand this block and this block. What is this? This is to reflect the markup, and this is to reflect the remaining stock. What's the answer?
72.
72? No, can't be. You get 72? Then how come we get 60 here?
0.812.
This is 4 over 5. This is 60. 60 into 4 is
240.
240. Okay. The issue is I already got 300. Yeah, I should not have this.
Yeah.
Yeah.
That's
And then the 60 is the cost. So to work out the profit, my calculation, I will change this. Sorry for that. Calculation will be like this: 1000 into into 25 over 125 into 30 over 100. Now you will get 60. This will be 200
240.
and then into 30 you get 60. Correct?
Yes.
So 60 is your unrealized. What is unrealized profit now? Unrealized profit, you see the parent company have sold goods worth of 1,000 to subsidiaries. The total profit they made was how much? We calculated that. The total profit they made was 200. Of that 200, still the subsidiary is keeping 30% of the goods with them. So for the group, there is a $60 still left as unrealized profit. So this calculation has to be very clearly understood, and this needed to be incorporated in the both the in the consolidation. What you now do, you have the your parent books, and another implication is about now this is a downstream, right? This transaction is a downstream transaction. In downstream transaction, entire profits of this 1,000, who is enjoying? Parent. So there is no one to share that 200, correct? So no, there is no problem of thinking about should we share a portion to non-controlling interest. So in downstream, adjustment is very simple. Okay? So I have the parent book here, and then subsidiaries book. In the parent book, I have the return earnings. Okay? In the return earning, we have already got this balance including this 200. I have reported that 200 included there. In the subsidiary books, I have inventory. That inventory balance here already included that 300. Correct? Because we said that 30% of the inventory is still with them. But they have shown at selling price to the group. We should reduce down to cost. So, in order to bring it down to cost, what I should do? I should eliminate the unrealized profit. So, what you do now? You remove 60 here and you remove 60 here. This we call it unrealized profit. This we call it unrealized profit. Remember, this is not a double entry because in two different set of books. In two different set of books, so this is not a double entry. The double entry here is it's not double entry, it's an adjustment. So the net answer, you will take this to consolidation. This is from whom? Parent to subsidiary. In parent to subsidiary, PC. Now if it happens upstream, if it happens upstream, before I go, can I repeat a question? You understood so far? All of you? Clear? Madam, you okay? Mr. Dia,
Yes, sir.
I'm seeing you. You okay? Good. Also?
Yes.
Good. Gentlemen, you okay? Right. So, now, upstream. Same example. Now the subsidiary selling goods to parent. 1,000. Markup 25%. 30% of the stocks are still with parent warehouse. Now, what's going to happen? You see, now we have total unrealized profit how much? 60, right? The total unrealized profit is 60. If it's a downstream, entire unrealized profit of 60, we removed from the parent profits. But now, this 60 is sitting in whose books? Subsidiaries books. So, now a question arises, how going to deal with this? Standard allows you 3 methods. Standard allows 3 methods. One method, what they do, they calculate to the extent of the group percentage. Now in this example, 80%. To the extent of the group percentage will be then how much? 48. And then you continue the double entries or adjustments. That you see, I have done the adjustment here. I made it 60. So here I should do it at 48. This is method 1. We call it to the extent of the group. Second one, so this is method 1. Method 2, include NCI also. Include NCI also, meaning 60, 80% to the parent, 20% to NCI. You get 48 here and you get 12 here. So what you do now, in the books of parent, or you can also say group, you have return earnings and you have inventory here. No, not inventory, sorry. NCI. And then we also have inventory here. And in the books of subsidiary, we have the return earnings. Now what happens is that there is another bit of a scenario. We have to give all the profits of the subsidiary to parent or to the group. From there you need to adjust it. So what you do now, you adjust like this. So I debit to return earning, I debit to NCI, and I credit to inventory. 48, 12 and 60. Understand me? So this is the second option given by the standard. Third option is gross. When I say gross, 60, just deal with parent only. Just deal with parent only, ignore NCI. But the best option is this one. This is the. If the examiner is silent as to which method to choose, then you should deal with it. So this is all about NCI. So this is one of the important adjustments. So the next adjustment would be fair valuation. Now, you remember we calculated goodwill. In calculating goodwill, and see, at the time of the negotiation, a parent company approaching the subsidiary, they need to agree the purchase consideration. See, they are not going to agree the purchase consideration like looking at this guy. They are not going to agree the purchase consideration just looking into this guy, but they will have to look into the details of the assets and liabilities the company has. So, at that time, the shareholders of the subsidiary has the right to bargain some additional amount that they need. They may say that, okay, we have a land. This land, 100 million is the cost, but we wanted to value this at 200 million. So there's if you remember earlier 16, we talked about valuation. So they may have the right to include that. So any fair value increase, or I would say adjustments, any fair value adjustments need to be incorporated. Let's say in this example, it's a building. Instead of land, I bring this example as a building. The cost of the building was 100. Fair value is 200. So at the time of calculating goodwill. Now you remember that equation, and I said that I need to have fair value of identifiable net assets. In that, if you remember, I have taken the share capital and I have taken the reserves. Now I will add one more line, fair value adjustment. How much is that? Difference between these two. So that is how much? 100. In addition to these two, I will take this and this I will subtract against the total of the purchase consideration and NCA, and that will give me goodwill. You understand that? So you have to factor or address the fair value adjustments in doing that calculation. Now what's going to happen now? When you prepare the balance sheet, you need to have your land and building. Now the land and building of the subsidiary will not be 100, but the land and building of the subsidiary will be 200. Another interesting point, let's say 1 January 2020, 1 July 2020, 31st December 2020. This is the date of acquisition. They have done the fair value adjustments, and then the building has extra 100. So after the acquisition, the business is in existence for 6 months. So then you need to calculate depreciation. So the depreciation, you need to add this 100 also. Let's say the remaining life is 20. So what you do is you divide this by 20 and only 6 months, sorry. So this will give you the depreciation for the additional 6 months. That needed to be adjusted as an expense. So this is about fair value adjustments. So when come to group accounting, the basics concept I have discussed all now. See, I could take up questions, but I don't think that will end value to us. And with this, I think I'm done with group accounting. The next session, I will do I have a slides. I'll just run through the slides, and then we will now start. Just to recover, in IAS, I think we have this. Did we included the 41? No, right? No. Yeah. Okay. So that means I have done all the IAS. Okay. There is one thing is missing. IAS 33. You want me to discuss? This is earnings per share. Okay. So earnings per share is left. Provision we discussed, right? IAS 37 we discussed. 38. Then after finishing this, next session we will start financial instruments. This is earnings per share. After finishing earnings per share, we will touch base financial instruments. This is 32 IAS, 32, 39, IFRS 7 and 9. Thank you so much.